SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner at Search Fund Ventures and founder of SMB Investor Network. And today I'm joined by Michael Huseby, who's the founder of the Investments Lawyers. And he's going to talk to us all about different aspects of limited partner agreements, what it means to be an LP, what you should kind of look out for when you're investing in limited partnerships and LLCs. So with that, I'll let Michael take it from here.
What's up? How's it going, Sean? Yeah, so I'm Michael. As Sean said, I run a law firm and we focus largely on PVs and all asset classes like private equity, private credit, venture, real estate, all sorts of stuff.
And you started your own firm after having a, pretty robust career in big law. What kind of drove you to make that, shift and what's it been like?
Yeah, I would say there's three main things for why I left. One was I started getting my own clients, and the incentive system of big law does not always appreciate that. So that's one. Number two was I wanted to automate big time, and that was a little bit hard to get through committee, basically impossible. And then third, I really liked and really respected a lot of partners at both big law firms that I worked at, but none of them had a life that I thought I would want. So I could think like maybe I'm like the exception and maybe like I'll do it differently, but I think probably I would not be the exception. So decided to do my own thing instead. So been running this for about 2 years and we have about 10 people now. We're going to have a new partner join us on December 1st, which I'm really excited about. But yeah, that's the deal.
Yeah. Well, when you look at when you look up the ladder and you realize, hey, even if I made it to the top, it's not necessarily where I want to be. That's a pretty good indicator that it might be time to start doing something else. And you also, you wrote a book recently, right? I don't know if you want to share anything about that with the audience here.
Yeah, I mean, it's basically just a somewhat simple how-to guide, which either GPs or LPs, so managers or investors, could read. That just explains how funds work and how special purpose vehicles work, and kind of walks through step by step how you would set one up and what the terms should be and what the laws are. The investment fund space can seem pretty confusing, and not a lot of people write about a lot of the lawyers don't want to share the secret sauce, so I just wanted to share the sauce. So it's written in very plain English, so it's I hope pretty readable.
Well, that's great, and it's I'm sure it'll be a good resource for anyone listening who's looking to understand better about funds, how they're structured, and even kind of syndications, SPVs, how those are structured as well. So, with that, would love to hear some of the themes you're seeing across your varying clients. I know you do a lot of work in real estate, you work with emerging fund managers, you work with some independent sponsors, folks of that nature. So what kind of, what are you seeing across that space?
Yeah. I would say over the last maybe 2 or 3 years, just kind of on the vibe side, there's been a bit, at least this was especially true last year. I'm not sure, maybe it's changing again. I'm not sure yet, but there has been more of a shift, I think, towards interest in cash flowing strategies versus appreciation strategies. So venture has been a little tougher to raise for. Things like, like the stuff you do, has been a little bit more in vogue, I would say. More LPs have been basically interested in what I would, maybe, things like private credit or SMBs or things where there's a pretty decent way to get money now as opposed to waiting for 10 years. This stuff always goes in cycles. So, venture will be back in 2026, I'm sure. But that's one thing I've been seeing. I think LPs are getting bigger LPs are getting a little bit more sophisticated and wanting to take more, I would say. And what I mean by that is the kind of typical way that a big LP invested before is they would just invest capital essentially and get a return, or maybe they get a special right here or there. But one thing that we've been seeing a lot is if someone's going to come in, they're going to be the anchor investor. If they have a giant check, they might try to weasel their way into the GP or the management company. So in other words, they get a share of the carried interest or promote or whatever you want to call it, the profits. The LP actually gets a share of the profits attributable to other investors. So that's something that we've seen a lot. And then finally, at least people who are on the internet, which is a lot of people, there's been a big shift. It's been a shift that's been happening for basically all my career, but it just keeps going, which is more people are using what's called 506c. And 506c, as you well know, is basically a way that you can raise capital publicly. We can get on this podcast right now and you could be like, Search Fund Ventures. It's a fund. I run it, like I think you might be finished raising capital. I'm not, well, I'll let you speak to what you're up to. But, if we're raising funds for deals, we can talk about it like this and we won't get in trouble. The hurdle there is you just have to have third-party verification that each investor is accredited, but it's a pretty low bar, and that's become much more common recently, as opposed to the old version where you cannot speak publicly, you cannot post on the internet, you cannot talk to anybody you don't know, really. So the shift to public has been pretty pronounced in the last several years.
Yeah, those are some really good call outs. Quickly touching back on your kind of GP stakes comment, if you will, do you have a ballpark estimate, even if it's just a range of like how big that investor has to be as a percentage of the total capital, say, to start asking for things like GP stakes? Is there sort of a pattern there, or is it just, hey, if I'm anchoring your deal, whether that means 10% or 50% of the capital, what does that anchor that gets a GP stake typically look like?
Yeah. It's kind of all over the place. So it really is like transaction by transaction. But just to give like kind of, very rough numbers, you wouldn't do it to somebody who's giving you 5% of the capital, maybe 20%, something like that. They might start to get the idea that they deserve a GP stake. Sometimes it's higher. And what they get is also quite variable. Um, I've seen anywhere from, I think, around 5% of the carry, um, up to 49%. So it's a pretty big range, but I would say kind of like a normal situation would be, they put in like 20-25% of the LP capital, and they get maybe like 10 to 20% of the carry, something like that. Sometimes they also get management fees, so sometimes they also go to the management company. Um, but those are a little bit less common than the pure GP stake deals. And those deals get pretty complicated. There's lots to think about. Like, for example, what about the next fund and the next fund and the next fund? Like, what do you get then? And there's restrictive covenants and all sorts of stuff, but I will not go down too many rabbit holes yet.
So just a summary, I mean, it sounds like, it's something that you're seeing occur more and more frequently, but there's not really a defined market yet. It's a little bit more of it's a tool in GP's pockets if they're looking to partner up more closely with a substantial investor. That's kind of where it's at
for
today.
sure.
It's not
And I think LPs are not afraid to ask for it either. I think they ask for it a lot.
Interesting.
And it's becoming common. It's hard to raise money, it's not 2021. And so people want a little bit, they want a little bit extra now.
That's a great call out for folks listening. And then, to the 506c point, yeah, we've also seen that, growing tremendously in popularity. A lot of searchers and independent sponsors, and I think in the real estate world, I'm less attuned to it, but my sense is it's going on there a lot as well. But more and more folks that are, raising publicly and filing 6C in order to do general solicitation. So yeah, that's a great call out as well. And I think you had noted the restrictions and it's continuing to become easier or more favorable to do that, even within the past 6 months or so. Is that right?
Yeah. There was basically what's called a no action letter, which is not a law, but I won't bore people with the exact process, but basically there's something that's kind of a law. It's a guideline that we're comfortable following. And the short answer, and it's not like an actual law. So what I'm going to say is kind of, it's our position. It's a very common position for lawyers to take. But basically, as I said earlier, if you're 506c, you have to do some sort of third-party verification to make sure each investor is accredited. And the short answer is that the SEC has suggested that if your investment minimums are high enough, which is 2K for humans and a million for entities, and you stick to that, and all your investors have that, satisfy those minimums, then it's kind of like a wink, wink, nod, nod. Like, yeah, I mean, if they're investing 200K and they're a human, they're accredited. Like, come on, SEC, like for sure. And the SEC basically said, fine. So we have a lot of clients who all of a sudden their minimums are now 200K for humans and a million for entities. It's our most common minimum at this point. Obviously, that only works if you're raising a decent amount of money and are not rummaging around for the $50,000 checks. But for some sponsors, it's a really nice way to do it because then you can raise publicly, but you don't have the friction of being like, here's the sub docs, and also here's this other piece of paper that you have to do. And like, as you know, like you want to reduce friction wherever you can. So it's a nice way to reduce friction.
Yeah. All right. Well, that's really interesting. It's going to be, the higher minimums for some folks may be a challenge, but it also reduces, like you said, the paperwork needed. So very good. I also wanted to cover with you a topic that a lot of investors, LPs that are part of our network, and also, GPs that are raising capital have a lot less of it, I would say, a defined market around, which is governance and minority protections, right? So if you talk about the venture capital space, there's pretty defined kind of minority protection. Same with PE, right? There's these kind of set rights like tag along, drag along rights,
Right.
your ROFRs,
Yeah.
or things like that appear in virtually all the LPAs or operating agreements. But there can be a lot of variance for folks that are raising on a deal-by-deal basis and emerging funds, especially with alternative strategies. There can be lots of different directions people take things. So what are kind of the top, 5 to 10 items you would say are key focal points for folks that are looking to understand kind of governance and minority protections in these investment documents?
Yeah, for sure. So the backdrop here is that in funds and syndications, the GP, the general partner, is basically dictator. So that's where we start from. The GP has all the power to make decisions, except for some stuff. And so the some stuff is what we'll talk about now. So there are some kind of easy ones to figure out, like investment limitations. So this doesn't make as much sense for a single asset SPV, but for a fund, it's like, well, you can't invest in things other than this. So you might maybe like, businesses with EBITDA of X, in the Southeast United States or something. So the investors know you're not going to take the money and go buy Bitcoin or something. There's leverage limitations. So, you can't lever the thing more than X percent. There are amendment provisions. So, the GP can't just go change the documents unless a particular threshold of LPs agrees, which is usually majority. This is not really like an investor protection, but something to just make sure about is that if the fund or syndication is going to sell an investment, then you should always check to make sure that the first thing that happens is the LP gets their money back. There are some situations in some types of funds where if there's cash flow, then the cash flow can get distributed, among the GP and LPs before there's been an LP return of capital. But dispositions, sales, things of that nature, the LP should always get the money first every time. There's provisions for GP removal. So if the GP commits fraud or something, the LPs can vote to kick them out. If the key persons of the fund, which are the principals, stop paying attention, the LPs can potentially shut the fund down or keep it from making new investments. And then the last contractual provision I'll hit on here is the restriction on affiliated transactions. So if I raise a fund, the prohibition here is that I can't then do a bunch of deals with the fund willy-nilly. I can't be like, I've started a venture capital fund and like I have this, these shares of this company and I'm going to sell them to the fund for like 5x multiple. There's stuff that says you can't do that. Usually any sort of affiliated transaction would require the LPs to consent to it. And then the last thing that I'll say, which is not really like an investor protection in the documents, it's an investor protection in the law, and that's securities fraud. And security, that's a scary word, and it is. But basically what it means is the GP can get in trouble if the GP does something that the GP didn't say they were going to do. So here's where like the marketing materials come into play. So even if, the contract, the LPA doesn't say like, this fund, like it's a real estate fund. It just says it's a real estate fund, but it doesn't really like have an investment restrictions section. And then let's say this real estate fund goes and, buys like a plumbing business. Like there may have been no contractual limitation on that. Maybe theoretically that's allowed, technically per the contract, but the whole time you were marketing, you were saying real estate, real estate, real estate. Even though there's no breach of contract potentially claim, the investors could still claim securities fraud. Like you said you were going to do this, and that's why you gave money, and then you did this. So that's, kind of a hook for LPs to think about. And it's also very important for GPs to think about. So when you're marketing, you want to be very careful about what you say you're going to do. And if there is a situation where, you really just think this plumbing business is amazing, you can always just ask the LPs to vote and be like, we were going to do multifamily, but we really like the plumbing market now. What do you think? So always keep securities fraud.
Those are some great tips to touch on kind of the first 7 that are more of, contractual type protections that will appear in the governing documents. The first tip, it sounds like for LPs would be, if you don't see one of those things in the LPA or the operating agreement, you might want to ask your own advisors or, look to the GP to put something like that in there, because what I'm hearing you say, Michael, is, if the starting point is a dictatorship with a minor amount of rights for LPs, the fewer those rights are, the less kind of protections, frankly, the
that's
LPs
right.
have.
That's right. That's exactly right.
So that's kind of a good sense check for folks listening for those first 7 items. The last one, it sounds like, is sort of a catch-all, right? If someone believes the GP is doing something they didn't say they were going to do, or kind of going against their mandate, or something similar, there's always kind of the SEC that you can turn to.
That's right.
To kind of back you up. Those are some good call outs in terms of how LPs can protect themselves when investing. And then I guess kind of similarly, what items, since you talk to a lot of LPs, I imagine, while you're, supporting GPs with their raises and documents and all that, what are some of the items that most frequently kind of come up or that LPs might miss in the documents, and where should they be, really focusing to make sure they have a full understanding of kind of what they're committing to?
Yeah. Well, the things that they usually bring up are the fees in the waterfall, because that's kind of like the stuff that they
The heads of
understand. And
terms, sure.
those are the headline terms, So those do get negotiated a lot, either by changing the documents for everybody. And so this is kind of like a quick negotiating point. Like the way you negotiate is you either change the deal for everybody. So like the fee was 2, and then you decide, nah, fine, the fee's 1. Or you could do side letters, which is basically a special deal between a fund or syndication on one hand and the LP on the other hand. And side letters are super common. So you can do that. And that's something sometimes people don't think about, because it can be really helpful for an anchor investor situation where they want a special deal, like they want the carry to be 20 instead of 30. And then instead of like making the whole fund dial down to 20%, you just do it for this one particular investor. So it's a good strategy for sure. Other things that LPs would want to look out for, other than, the ones we already talked about. One would be liquidity. So you should always know when you're going to get your money back somehow. There's basically 2 models for how funds and SPVs work. One is called closed end. And in closed end, there's kind of 2 branches there as well. In a closed end fund, the fund lasts for a particular time period. So maybe it's 7 years or 10 years or something like that. At the end of that time period, the fund shuts down. So that's how you're going to get your money back. Hopefully it's going to shut down at some point. For SPVs, a lot of the time it'll be closed end, but the end is not defined. This is not common at all, like impossible almost for funds, but it does happen in single asset deals sometimes. So like you buy, an HVAC company and you're just kind of locked in until it's sold. Or same thing with like a real estate transaction. Very commonly there's no term. So it's not to say you shouldn't do the deal. There's lots of setups like that, but you really want to know what's going on. Like, what's the plan? When are they planning to sell the asset? In some cases, you might try to negotiate for some sort of liquidity right, whether that be the right to transfer to somebody else or the right to have like the fund redeem you after a certain period of time. That's not going to work unless you're like a really important investor, because the GPs don't want to deal with that. So those are the closed end varieties where essentially LPs are locked in until a particular date. The other type of funds are called open-ended funds, and these are a bit different. Essentially, the fund lasts forever, but LPs can redeem over time subject to limitations. The limitations usually being, one's called a lockup period, which is probably familiar to people. Your money is stuck in for some amount of time, a year, 2 years, whatever it is. And then usually there's a gate. And a gate just means that you can't withdraw all your money at once. Maybe you can only withdraw 25% in a calendar quarter. So it takes you a year to get out. So as you can probably see, there's a lot of different models here, but you should at least know what you're doing. And we are working with a fund now who is not pleased with their previous lawyers, and for good reason. And one of the things that ended up is that they somehow ended up with a closed end fund with no termination date. So in other words, the LPs are locked into a closed end fund for the rest of their lives, and there's no redemption mechanics. So like this was the, I don't know whose fault it is. Maybe it was the previous lawyers, maybe it's the client. We can argue. But as an LP, you need to read the documents and understand what you're doing. Because like this fund raised millions of dollars and all these LPs just signed the docs and didn't like notice, I guess.
That sounds like the zombie fund of all zombie funds,
Yeah.
potentially.
I mean, crazy stuff like this happens. It's not the first time I've seen some bizarre stuff. So if you're going to invest, your hard-earned money, figure out how you're going to get it back. So that was a bit of a rant on liquidity. Ultimately, like there is some risk to putting your money into a private investment instead of just buying S&P 500, indexes. And so, in many cases you can get a higher return, but you need to know how it works.
Yeah,
So
no doubt.
yeah, go ahead.
It's a really good concept to hone in on, because I think, like you touched on, a lot of people focus on, the headline stuff like fees, carry, what's the target return going to be, but definitely more sophisticated investors frequently ask less about target return, how are you going to get there, and ask more about what is the risk that, some of these assets aren't going to be liquidated in time, and what do we do if they aren't, right? And
Yeah.
obviously there's a lot of press right now on continuation vehicles. Some of that ties back to your affiliate transactions kind of protection. So all these things, as folks who are listening, you can see, are kind of go in a circle, right? You don't want to be tied up in a fund that lasts forever, where you could hold the investments forever. There's no liquidity, and it's really hard for LPs to get their money out. But you also don't necessarily want to be in a fund where you're approaching the end of the fund. A lot of the assets aren't liquidated, and there's limited restrictions on affiliated transactions, and that GP can just go, sell those assets to another vehicle of their own and mark a
Yeah.
really nice return on their first fund. So it's critical. I think you'd probably agree with me, Michael, that LPs look across all those different items to make sure that the full package kind of makes sense, right?
Yeah. Yeah. And one thing that LPs can do usually is they can vote to extend the term of the fund if they want to. So if they don't really want, if there's kind of a risk that the market's down, we don't want to sell the assets now, they can extend the life of the fund. And usually on the continuation fund front, those are beast transactions, by the way. Those are just, they're so complicated. That was one of the last things I worked on in Big Law. But usually the LPs have the right to exit or roll. And so there's a lot of like mechanics to protect the LPs in that process. But like you alluded to, when you're selling it for one thing you own to another thing you own, there's always, there is an inherent conflict of interest. So on the LP side, pay attention. And on the GP side, really make sure you're dotting all the I's and crossing all the T's as far as disclosing everything, because you don't want to get whacked later on by disgruntled LPs.
Very good. I think there were a couple other items you wanted to cover on the,
Yeah, for sure. So another piece that's important to understand is the fund expenses definition. So in funds and syndications, there's a term, capital F, fund, capital E, expenses. And I'll kind of just describe how expenses work. So there's kind of two types of expenses in funds and syndications. And so a lot of people will know about the management fee. The management fee is an ongoing fee that the GP or technically its affiliate gets over time for managing a fund or a single asset deal in some asset classes. In venture, this is not very common, but in like private equity, independent sponsor, and real estate, it is common. That fee, let's say it's 2% of the fund size payable every year, which is a common one. That payment goes from the fund to the management company. And the management company is where the fund principals work. So the management fee is used to pay the fund principals their salaries, pay for their office, pay for like GP level accounting for the GP entity, things of that nature. So that's what the management fee is for. Everything else almost is a fund expense. And a fund expense just means that the fund just pays for it. So in other words, the LPs and the GP, to the extent of its capital contributions, pay for it. And so that's a lot of stuff. The list of fund expenses is very long. And like some common ones are, legal to set up the fund, accounting, diligence, certain types of insurance. I mean, I think like in our documents, it like goes up to like number 42 or something. Like there's a lot of stuff that we list in the fund expenses definition. And so this is stuff you could think about it as an LP, where this is the list of stuff I'm paying for as the LP. And so you want to look at it and see whether it makes sense. This is also kind of a shift that at least we've seen, where I think a couple of years ago, I think we cut down the list of fund expenses from 50 to 43, so there's some stuff that we've taken out after LPs have. So LPs should look, just see what's in there. It is very common. The scheme I just explained is very common, where the fund pays for all this stuff directly. That is how funds work. But, you don't want to see in there Sean's Ferrari, for example. If you see that in the fund expense definition, you're going to want to take that out.
Gotta impress my portfolio companies.
That's right. I think I posted about this on like LinkedIn or something yesterday, but there's a couple funds, not at my current firm, but at previous firms that, for example, had tried to make private air travel a fund expense. So the LPs pay for it. And understandably and probably correctly, neither of those GPs actually raised their funds. So LPs did not go for that. Air travel to look at investments is typically a fund expense, but you should probably keep it to commercial. Maybe premium economy if you're doing really well, but
fun. Those are fund 2 goals, right?
Those are fund 2 goals. That's right.
Yeah, the fund expenses is a really good call out because there can be a lot of variance in there. As the more and more investors, more LPs I've spoken to, a common, I would say, framework to think about fund expenses through is to say, are these expenses that are actually creating value for limited partners or not?
Yeah.
Right. So travel to go diligence a portfolio company or meet with portfolio company leaders or things of that nature probably adds value, as long as it's not, as indiscretion, right? Things of that nature typically make sense. But to your point, Ferrari's high-end versions of travel to see portfolio companies, the value starts to erode to some degree.
Yeah, to a large degree. And from the GPs out there, it's important to note that just as far as like a cash flow, when you're thinking about your own personal cash flow, when you start a fund or you start a syndication or whatever, you're going to have costs before the fund actually closes. So like you might have to pay legal fees or like accounting or form entities or travel to find investors or things like that. Um, at the initial, so as long as those things are fund expenses, which often they are, then you had paid that sort of stuff out of your own pocket before the initial closing, and then at the fund's initial closing you call capital to reimburse yourself for that sort of stuff. So you and I have each raised funds, and that's a very exciting day when you finally get reimbursed for all the stuff you spent money on.
Yep, that's another good, yeah. The expenses and fronting the expenses, all that stuff, it's not unlike bootstrapping a business in many ways.
Yeah.
So yeah, important things to focus on as an LP. I think, if we jump to the waterfall, I think that's one we wanted to talk about because, it's in every investment, however it's structured. So maybe some quick kind of tips on, common waterfall structures you see, how to review it, or any kind of, items that might stand out in recent waterfall structures you've been seeing.
Yeah. So I'll kind of like talk through maybe 3 or 4, starting with the simplest and getting kind of wild. So the simplest is like in an SPV or a fund in venture capital style deals. And so that basically means like this. Now the waterfall basically is just when we have money to distribute, where does it go? That's what the water. So in many simple VC style funds and syndications, the waterfall will be 2 steps only. Step 1 is if you have money, the LPs get all the money until they have received a return of their capital. And then any profits are split 80% to the LP, 20% to the GP. That's kind of the most common thing we have. In real estate and private equity, private credit, there's usually something called a preferred return. So it's an extra step. So the first step, if you have money, is give it to the LPs until they get their money back. The second step is then give the LPs some extra money until they've cleared a certain hurdle rate, like 8% on their capital or something like that. And then now third is the 80-20 split or whatever it is between the GP and the LP. So that's kind of more common for the asset classes I mentioned. There's kind of a complicated thing, which I hesitate to mention, but I'm going to do it for completeness. It does get kind of confusing. It's called the GP catch-up. What it is it basically acknowledges the fact that, like, let's say we're going for 80-20 at the end of profits. The preferred return actually is a distribution of profits, but it goes only to the LP, not to the GP. And so if you think about it, like if you do preferred return then 80-20, the GP does not end up with 20% of the profits because like its percent is kind of getting dragged down by the preferred return it already paid. So there is kind of a more complicated but very common model, which goes first return capital, second preferred return, and then third, the GP gets its own priority return such that it has received 20% of the profits and the LP got 80% to the preferred return. So it's kind of like a little preferred return for the GT and then 80-20 at the end. So that is, I would say, probably the most common as far as like institutional funds are concerned. You usually have a GP catch up if you have a pref for like bigger, fancier funds. There are for sure deals out there that do not have the catch up, but a lot of them, at least the more sophisticated ones, do. And then, so in respect of any of those types of waterfalls, as the LP, and I kind of mentioned this earlier, you always want to make sure that return of capital is a step. Now, sometimes the preferred return will come first and then the return of capital. That's also fine. Just make sure there's a return of capital somewhere because, I've seen other people I know have seen just outrageous waterfalls that make no sense at all. Like, just they boggle the mind. Like, for example, I've seen this before. The waterfall just says any distributions are 50-50 between the GP and the LP, which is just like completely nonsensical. It creates a tax issue. It's basically stealing. The idea is that, like, you could raise $100 and then just distribute it 50-50, like there was no return of capital. So it's crazy that people would sign these things, but they do. So always check for the return of capital. So now here's like the most complicated thing, which is in some ways an exception to what I just said, but not really. So you may be able to identify kind of a practical problem with this whole return of capital first situation. And that practical problem is sometimes you buy something really nice and you want to keep it forever. And so if you do that, you kind of have a problem. The waterfalls I just mentioned work very well if you're just going to like buy something and then sell it 4 years later, because your returns will be quite high. But let's say you're just buying like a nice, decent business and it's throwing off, 8 or 9% cash on cash every year. And everybody just thinks, what a wonderful asset. Let's never sell it. Well, if that's the case, you have a problem because you have a return of capital step and an 8% pref. You're just never going to clear it. It's not going to happen. So the GP is never going to get to the carried interest because there's no big capital event to return the capital. So what a lot of people are doing these days in more of a buy and hold strategy is they'll have two waterfalls. So if you sell or in many cases refinance the investment, you do what I just talked about, return of capital, pref, blah, 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 blah. But then if there's cash flow, just straight up cash, dividend income, operating income, whatever you want to call it, that has its own waterfall, special waterfall where you take out the return of capital step. And so you could just do, you can do it in 3 different ways. One, which is the most aggressive for the GP, is just cash flow split, let's say 80-20 right off the bat. So we see that. Another one is preferred return, then 80-20. And then another one is preferred return, then GP catch up, then 80-20. So it's basically all the stuff we just talked about, just with the return of capital step missing. For buy and hold stuff and private credit as well, because the same kind of problem exists in private credit. That's something that is out there. So that's kind of an interesting tool for GPs if they want to, buy and hold, but also something for LPs to look at. I guess the last thing I'll say about waterfalls is sometimes funds, in addition to everything I just said, have like extra hurdles where if they clear certain multiples or IRR thresholds, then it goes up. So for example, you could have a fund that says it's 80-20 until the LPs clear 10% IRR, and then 70-30 until they clear 20%, and then it's like 60-40 or whatever at the end. So I think the record that we did this year was a fund with 11 steps in its waterfall, which is a lot. So I wouldn't always suggest that we get down to like letter M or whatever in the alphabet. But people do get quite creative with these sorts of things. So that was quite the waterfall rant, and I yield my time to Mr. Smith.
No, that's great stuff. You are the expert on all things waterfalls. So it's great to get your take, and thank you for sharing with me and with everyone listening. We only have a minute or so left here, so maybe you want to share with everyone how they can get in touch with you if they have a need for, reviewing waterfalls or fund expenses.
Yeah, sure. And so just the little plug here is that now we do more than just funds and syndications. We do M&A, we do venture financings, we do normal corporate work. So if you, Sean, or anybody else, needs that sort of thing, we got it now. The website's very simple. It's til.law. We also have a newsletter that goes into how funds and syndications work. It's called fundamentals.law. And then there's, as you suggested, a book on Amazon called Fundamentals, which is a book which you can read if you're a nerd.
And it was a bestseller in its category at one point.
It was a bestseller.
That's
the bestseller rules are a little bit like, it's like time bound. But yeah, for that like 2 or 3 weeks, I'll tell my mother I was a bestseller. It's technically true.
That's what matters.
That's right.
Awesome, Michael. Well, thanks so much. It's great having you, and appreciate
Yeah,
you
thanks for
sharing
having
your
me, man.
insights.
Good to see you as always. All
Take
right,
it easy.
thanks, man.